What sets apart the 10% of successful investors from the rest? In a world where 90% of investors falter, Buffett's unparalleled wisdom stands tall as a beacon of financial prosperity. From patient long-term vision to underrated discipline, each rule unveils a profound philosophy that sets him apart. In this video, we all delve into the mind of the Oracle of Omaha and learn the 7 rules to navigate the tumultuous seas of the market with confidence. Achieving such success in anything requires following a set of rules, which are distilled wisdom from years of experience. Even successful football players win by avoiding penalties and honing their training. Similarly, successful students get A's by adopting effective study habits. Investing in the stock market follows a similar pattern. Success in investing can lead to significant financial gains. Warren Buffett, a renowned investor, openly shares his insights on making money in the stock market. Fondly known as the Oracle of Omaha, Buffett has been Berkshire Hathaway's largest shareholder since 1970. His consistent outperformance in the market is attributed to his ability to identify quality companies and purchase their stocks at fair prices. Much of his investment approach is influenced by Benjamin Graham's value investing principles. In your pursuit of investment success, it is wise to follow in the footsteps of those who have triumphed before you. By learning and applying Buffett's best investing tips, you significantly increase your chances of achieving success in the stock market. Before we dive deeper, make sure to hit that like button and subscribe to this channel for more incredible, life-changing content. Now, let's move on. Here are 7 investment rules from Warren Buffett for making money in the stock market. Number 1. Never lose money. Rule number 1 in investing is to never lose money. And rule number 2? Well, it's just as simple. Never forget rule number 1. If you start with a loss, it becomes tough to bounce back and make gains. To avoid losses, Warren Buffett advises buying with a margin of safety. This means buying an investment at a price lower than its actual value while being cautious in your assumptions. The idea behind this is that you want to get a good deal on a business so that even if your evaluation is off, you won't lose much. As an investor, your main goal is to make a profit. But one of the best ways to do that is by avoiding losses in the first place. By making decisions that protect your portfolio from losses, whatever is left has a higher chance of turning into gains. And when your portfolio grows, you can compound your gains even faster. Buffett's approach to investing has big implications. Instead of chasing the highest possible gains, he suggests focusing on preventing losses first and then considering gains. This is different from the mindset of some investors who treat the stock market like a gambling machine, hoping for huge wins without much consideration for potential losses. Number 2. Invest in businesses you understand. When you invest your money, don't pick businesses you don't understand. To invest wisely, you need to be able to predict how a company will do financially in the long run, like 10 or 20 years from now. Stick to what you know and understand. Warren Buffett's famous advice is don't invest in a business you can't understand. It means you shouldn't invest in something you don't fully grasp, but it doesn't mean you can't learn about new things. If a company's business is way too complicated for you to figure out, it's better to avoid it. Don't fall for the trap of buying a stock just because someone told you to or because the stock chart looks promising. Successful investors know what they're investing in. They believe in the products and services of the companies they buy stocks from. They also do their homework and thoroughly analyze the company's financials to make sure they're making smart choices. Sometimes, the best opportunities for huge gains come when a stock has faced some challenges or has already gone up a lot in value. But to stick with such investments, you need to have strong confidence in the company's potential, which comes from truly understanding it. Always invest in what you understand to increase your chances of success. Number 3. Focus on long-term investing. Focus on long-term investing and don't get spooked by short-term price swings. Hold on to good companies unless there's a solid reason to sell, like management issues or needing money. When you invest, think about the long haul. Warren Buffett says you should feel like you own a piece of the companies you invest in. The goal is to buy shares of a simple and understandable business at a reasonable price, knowing that its earnings will likely grow significantly in the next 5, 10, or 20 years. So, be patient and don't rush to sell. Trying to time the stock market or taking big risks to get rich quickly is like gambling. Successful stock market players are investors, not speculators. They think differently and smarter, focusing on the long game. If you can think long-term and see beyond the daily ups and downs, you gain an advantage. For instance, when American Express was facing troubles in 1964, Buffett saw the potential and bought its stock. The best investors don't let short-term problems scare them away. They keep their eyes on the distant future. Number 4. Look at the intrinsic value of a company. When you buy shares, try to get them at a price lower than their true worth. Look at the company's intrinsic value and only invest if it's undervalued, without letting emotions cloud your judgment. Many investors act emotionally, which creates great opportunities for value investors like you who see quality companies that are unfairly priced. It's like finding a good deal on something you want. Focus on buying excellent companies at a reasonable price rather than settling for average ones at a huge discount. While you can still make money with discounted stocks, it's better to invest in wonderful businesses at a fair price. That way, you have a higher chance of building your wealth over time. Warren Buffett emphasizes the importance of getting high value at a low price. He says that the price you pay for something doesn't always match the value you receive. It's like buying quality merchandise on sale, whether it's socks or stocks. Always look for opportunities to get more value for your money. Buffett's approach as a value investor is to buy top-quality stocks at rock-bottom prices. His main goal is to increase the operating power of his investments. To do this, he sets specific criteria for choosing good businesses and sticks to them. For instance, he looks for companies with a durable product or service, solid earnings, and potential for future growth. He also considers factors like market capitalization, price-to-price earnings ratio, and debt level. Finding the right company at the right price with a margin for safety against market risks is the ultimate goal for successful investors. Number 5. Don't miss big opportunities. Don't let big opportunities slip away when you spot them. Warren Buffett's biggest regrets are often not taking action when he knew he should have. When opportunity knocks, don't hesitate, open the door wide. As Buffett put it, every decade or so, economic skies will darken and it will briefly rain gold. When those golden opportunities arise, we should be ready with our wash tubs, not just tiny teaspoons. These opportunities don't come around often, so when they do, act swiftly and decisively. When the odds are in your favor, like when stock prices are down significantly, that's the time to go all in with your investments. It's like buying low and selling high, but in this case you're buying low with the anticipation of selling high in the future. Being patient pays off because you'll find plenty of chances to purchase great stocks at dirt cheap prices. To make the most of these opportunities, make sure you have some cash in your investment portfolio. Having cash on hand during the good times allow you to take advantage of temporary market downturns. This is precisely how Buffett operates. He accumulates cash during the bull market and then goes all out when stocks take a plunge. Having a safety net of cash enables him to capitalize on these moments. Number 6. Be fearful when others are greedy, and be greedy when others are fearful. Investing can be a lot about understanding human behavior. Warren Buffett's famous advice is, be fearful when others are greedy, and be greedy when others are fearful. Let's break it down. When investors are greedy and overly optimistic, they tend to push stock prices to sky-high levels. At that point, Buffett becomes cautious and fearful because he knows that a market downturn could be around the corner. When everyone is excited and buying like crazy, it might not be the best time to join the party. On the flip side, when investors get scared and start running away from the market or certain stocks, Buffett sees it as an opportunity. He gets interested because when prices drop, stocks become cheaper, and there's a chance to get good value for your money. Lower prices mean lower risk, and that's how Buffett aims to avoid losses. While some investors focus solely on the numbers, Buffett understands that investor behavior plays a significant role in the stock market's ups and downs. When others are overly greedy and optimistic, he gets cautious. But when others are fearful and running away, he gets interested because he knows that's when the best deals can be found. It's important to pay attention to how others are behaving in the market. And when everyone is too optimistic, be careful. And when everyone is fearful, be ready to take advantage of the opportunities. Keep an eye on the human side of investing, not just the numbers, to make smart decisions and avoid unnecessary losses. If you find this video informative, like and subscribe to the channel for more educative content. Let's continue. Number 7. Diversify your portfolio. Diversify your portfolio. Don't put all your eggs in one basket. It's a crucial strategy to protect your investment, so if one stock does go south, it won't sink your entire investment ship. Even the best investors make mistakes, so spreading your investments across different assets reduces the risk of any single failure hitting you hard. There's real power in diversification. However, while diversification is important, it's also essential to focus on your best ideas. Your top 1 or 2 investment picks will likely perform better than your 100th choice. So, while you spread your investments, make sure you prioritize your most promising opportunities. Warren Buffett emphasizes that when you're lukewarm about a business or its price, avoid buying a little of this and that. Instead, when you're fully convinced of the attractiveness of a particular investment, go ahead and buy a worthwhile amount. It's about being confident and committed to your best ideas. The key is to strike a balance between diversification and concentration. Diversify to spread risk, but concentrate on your strongest convictions to make the most of your investments. There's no doubt that Warren Buffett is an exceptional investor. He's achieved this status by following some fundamental rules for buying and holding investments in his portfolio. So, take these principles to heart, stay committed to your goals, and watch your investments soar. Don't forget to like, subscribe, and share this video with fellow investors on the path to financial prosperity.